Bloomberg Audio Studios. Podcasts, radio, news.
The Stock Movers Report, your roundup of companies making moves in the stock market, harnessing the power of Bloomberg data.
Well, let's take a look at some stocks on the move today in Europe. I'm Stephen Carroll and I'm joined by Bloomberg's breaking news editor, Louise Moon. Louise, good morning. Let's start then with UniCredit this morning, Italy's second largest bank, reporting profits and revenues that beat expectations.
Indeed. However, despite that, it is among the worst performers in the Stock 600 Banks Index. This is their third quarter results. As you say, higher profit, higher revenue, net income, their key metric, beat estimates. But essentially, this is failing to impress investors. Instead, they're focusing on the lower net interest income and the prospect of higher bank taxes in Italy. So analysts are questioning, the quality of that beat and saying, although these earnings came in relatively solid, they weren't really enough to excite the market. It's also worth noting they didn't upgrade their guidance. Analysts are also noting that they confirmed it, but no upgrade. And it kind of, take a step back, it underscores the challenge for the CEO. He's streamlined the business a lot since taking over in 2021. That's boosted their share price highly. And then he kind of went on a takeover spree from there. But the most recent efforts, that's to buy Banco BPM, that failed. And so now there's a lot more focus and pressure to boost the business itself, to focus on execution at UniCredit itself. So solid earnings, but failing to impress, as there's nothing really to cling on to in terms of looking forward.
Okay, well, turning next to Adidas, slumping after currency rates weighed on its third quarter sales figures.
Indeed, yeah. Shares fell as much as about 5.5% this morning, and they're down about 20% year to date. So they have their third quarter results as well. Revenue fell slightly shy of estimates, weighed down, as you say, by foreign exchange movements. That was cited as quite a large headwind. They did, however, raise their forecasts. That was for operating profit. So even though the market is reacting quite negatively, there was still some positive news. They raised that forecast, citing things like brand momentum. However, that was in line with what analysts had already expected. So that was already priced in. That's why the market is reacting as it is. So analysts are saying they're not really expecting major revisions going forward. Adidas has essentially been having quite a good streak in terms of products for the last 2 years. They've revived some of their retro trainers, and they're now trying to really maintain that momentum going forward.
Okay, so that's the latest from Adidas. And next to ITV, falling after Liberty Global sold a roughly 5% stake in the media company.
Indeed, yeah, dragging the FTSE 250 far lower this morning, and ITV plummeted to its lowest since April. So Liberty Global is its largest stakeholder, and they sold half of their stake. So they sold a 5% stake in ITV. That was for £135 million. So Liberty Global had invested in 2015. ITV shares since then have fallen about 70%, and so they're essentially taking out their losses. Essentially, they say they're divesting as part of their process. They're saying they're actively managing their portfolio and prioritising what they're called scale-based investments. But it's an interesting one considering ITV's share price movement, and also considering that ITV has been the subject of a lot of takeover speculation, and Liberty was speculated as a possible buyer. But now that they've paired their stake, that obviously seems increasingly unlikely. So we'll be watching that.
The Stock Movers Report from Bloomberg Radio. Check back with us throughout the day for the latest roundup of companies making news on Wall Street. And for the latest market-moving headlines, listen to Bloomberg Radio live. Catch us on YouTube, Bloomberg.com, and on Apple CarPlay and Android Auto with the Bloomberg Business app.